Our next guest warns the tech slump could last a year. Jonathan Golub is a chief U.S. equity strategist, head of quantitative research at Credit Suisse. Jonathan, great to have you with us. Let's say the slump does last for a year. What does the market do with that context if technology is the leader?
Yeah, I'm not sure and I'm not sure that was the right quote, that I think tech is going to slump. What I think I said was that I think that cyclicals are going to be a winner as long as we have disruptions in the labor market that are causing lots of inflation, and that they just have more leverage and exposure to rising commodity prices like we're seeing today, and disruption in supply chains tend to give them more pricing power, and they have more operating leverage. And in that world, they just end up being a winner. But I'm not, longer term, I think these growth names are going to be absolutely the right place to be, but not in a period of time when you have this kind of disruption in the market and economy.
What is that period of time, Jonathan? I'm just trying to understand what investors should prepare themselves for in light of your bullish call on cyclicals. What happens to tech in that context in the shorter term? I mean, it can't be a market where everything rises. I mean, I guess it could, but what do you see?
Right. Well, no, you're asking a couple of questions here. The first thing is, how long, how do I define this environment and how do I think about that? I mean, way back when the Fed was calling, way back when, may have been 6 months ago, the Fed was talking about inflation being transitory. But I think that their view was that inflation was being driven by easy monetary policy and a lot of government stimulus. And now we're actually seeing that the aftermath of the initial pandemic is playing out with, shortages all over the place, supply chains, and in the form of chips and labor everywhere that you look. And now you're seeing this in energy. And there's a real breakdown between supply and demand all throughout the economy. And the idea that this is going to magically resolve itself in 3 to 6 months, I think we're going to be disappointed that it's going to last a bit longer. I don't know whether longer is 18 months or 36 months, but these issues are going to take a little while. They're going to get better, but they're going to take a while to work through. And the question that we have to ask is, what types of companies tend to do well in this kind of environment? And it's those companies with lots of fixed overhead. If you have a software engineer, they're going to ask for a raise if there's a lot of inflation. But if you're a manufacturing company and you have equipment that you're leasing, it doesn't get a raise. It holds that same steady cost. So those fixed overhead, old-fashioned businesses, I think they are doing better here in delivering better profit growth. Just one more point on this. Value is expected to deliver, not the Credit Suisse view, consensus across all of Wall Street. Value is expected to deliver faster EPS growth than growth stocks are for each of the next 4 quarters. I don't even remember a situation like that.
Jonathan, Tim correctly points out that at 1.5%, the 10-year yield smack in the middle of this range we've been in probably for the last 9 to 10 months-ish. Is there a level where, you start to get very concerned in terms of what it means for the equity markets?
Yeah, first of all, I think Tim's point is right. I mean, a 1.5 interest rate by itself should not be a freak out at all. What is changing, though, just remember back to when we got the announcement about the Pfizer vaccine in early November, and interest rates go from like 80 basis points to 170 over 5 months. What did the market do? It didn't sell off. It went crazy to the upside because it was the economy and the improvement in the economy that was driving interest rates. Now what's driving interest rates, and look when they shifted direction. On September 22nd, when the Fed basically signaled that November is when they're going to start tapering, and now you have higher interest rates being imposed on the market, and the market is basically saying they're not happy. So it's not the level of rates, it's the tone, it's a loss of liquidity that I think right now is biting the market a little bit.
Jonathan, great to speak with you. Thank you.
My pleasure.
Jonathan Golub, Credit Suisse. Karen, You know, what struck me was when Jonathan threw out, we don't know how long some of these supply chain issues are going to last, and he just threw out, you know, off the cuff sort of, I don't know if it'll be 18 months or 36 months. That's a long time. I don't know if anybody really thought it would be all the way up to three years, like even as an outer bound.
Yeah, I don't think so, but who knows? I would have thought that it actually would have been resolved by now. But I think that some of these issues will get resolved in terms of, I think, you know, sort of gridlock at the ports. I think that will get resolved. Some of the other things about supply chain and moving your supply chain, I think those are a little longer. So, but he makes an interesting point on, you know, this companies with fixed cost, and then when they have inflation, that's when they're able to pass on inflation to their customer, that's a great business for them. It's like a United Rental.